There is an undeniable rush to buying into unproven, early-stage tech stocks. You are chasing market hype, banking on future promises, and hoping to get in before the stock explodes. Warren Buffett rejects that game entirely. He ignores future projections and focuses strictly on auditing the past for relentless consistency. The popular advice to just buy good products you know is a trap. It lacks any objective mathematical framework to filter out bad investments. Pinpointing a durable advantage in a company like Coca-Cola has nothing to do with how the soda tastes. It requires digging into decades of historical financial documentation. This quadrant chart maps your analytical effort against your risk of capital loss. You have a clear choice: accept the high risk of trend chasing or put in the intense, high-effort labor of value investing to protect your capital. If you are unwilling to sit down and read a company's income statement, balance sheet, and cash flow statement, you have no business picking individual stocks. You are merely gambling. We start our three-pillar scorecard with the income statement to measure profitability. The goal is verifying uninterrupted earnings growth over a minimum of 10 years. We apply our first strict rule: gross margin must consistently stay above 40%, just like Apple's data. This threshold proves immense pricing power, showing they don't suffer from escalating production costs. We then establish a secondary hurdle, a net margin of 20%. Apple passes this threshold, while competitors Samsung and Huawei fall drastically short, revealing an incredibly smooth operation. The trade-off here is absolute. By enforcing these strict margin rules, you explicitly disqualify yourself from investing in exciting, early-stage startups that operate at massive losses just to acquire new users. Next, we move to the middle pillar of our scorecard, the balance sheet. This tells us if a company is financially self-reliant. A new bar chart tracks retained earnings, revealing a steady, unbroken trend of the company reinvesting its own net income to fund growth. Investigate the context behind these numbers, as extensive buybacks or dividends can stall retained earnings. Looking at the debt, a durable company must be capable of paying off all long-term debt using less than 4 years of its current net earnings. Passing this debt test proves the business can survive major economic downturns. They won't be forced into the arms of predatory lenders or banking institutions just to keep the lights on. Adhering to this extreme debt rule comes with a cost. It will permanently lock you out of heavily leveraged, capital-intensive industries like real estate that rely on massive, debt-fueled boom cycles. Finally, the scorecard shifts to the third pillar, the cash flow statement. This document strips away accounting metrics to reveal the actual movement of cash. You are looking for the most dangerous drain on cash: capital expenditures, the money forced into maintaining physical properties and equipment. This gauge represents our final threshold. An exceptional business must consistently keep CapEx below 25% of its total net earnings. A consistently low CapEx proves the company does not have to bleed money into constant machinery upgrades just to keep pace with competitors. The ultimate benefit of this operational efficiency is a massive leftover cash reserve. That money compounds tax-free and can be distributed directly to the shareholders. This severe 25% limitation purposefully disqualifies traditional infrastructure and heavy manufacturing. If you follow this rule, your portfolio will be entirely devoid of those classic sectors. Finding a business that successfully passes all three of these pillars earns it the ultimate holding period: forever. But even a forever stock has mathematical limits. This decision tree flowchart maps out the 3 specific instances where you must sell. The first trigger is obsolescence. If the underlying economics change permanently and the competitive advantage is destroyed by disruptive technology, like online media replacing local newspapers, you cut it loose. The remaining triggers are situational. As the branches show, you sell to liquidate and acquire a vastly superior asset during a bear market crash, or you sell into a crazy bull market when the stock's PE ratio climbs above 40. If you are an optimizer willing to replace emotion with this objective 3-statement checklist, this rigorous auditing system will actively protect your capital. But if calculating historical CapEx ratios and reading decade-old annual reports sounds like a miserable chore, accept your limitations. Avoid individual stock picking entirely and settle for the automated safety of an index fund.